Right, in this video I'm going to be giving you the simplest guide to reading the markets. I'm going to be showing you how exactly the markets move, what causes the market to move, why does the market move. I'm going to be breaking down absolutely everything in this video for you. Let's get right into it. Right, in trading, the market structure is the number one thing above everything. Identifying where the market wants to grow is crucial for knowing when to get at the right time. So knowing where the market wants to go, if it wants to go up or down, this is, like the most important thing for you to know, like where and when to get in. Because if you don't know if the market's going to go up or down, you're not going to be getting in at the right time. You're just going to be gambling pretty much. It's just going to affect you in the long run. You're going to be hitting a lot of stop losses and you're going to be very, very confused. So structure is very, very important because it literally gives you the direction where a market wants to go. So structure allows us to understand if we're in a bearish or in a bullish market. In a bullish distribution, what we have is this is when price is printing highs, then breaks them, giving us true breakup structures. I'll go over what that is in a bit, showing strength and buying pressure. So exactly works. So essentially what this is obviously we understand that there's a high being printed. We have high highs, high lows, high highs, high lows. When we see that trend being respected, and we can see our previous highs getting overcome and we print a new high, this is what allows us to understand that you have a bullish distribution and price wants to go higher. Now for bearish distribution, this is the same as bullish. Only difference is price is printing lows and we break below them, giving us a true breakup structure to the downside. So the exact same concept applies to this. This is when we have lows being broken and price creates a new low, and that low gets broken and we create another new low. Very, very simple. Now, this part is key in identifying when we have a true breakup structure, when the market breaks structure and forms a new high or a new low, and validating the previous structure. The true breakup structure is very, very important in trading order flow properly. Why? Because the market likes to give a lot of fake moves. So when you understand what the true move is, when the market is actually breaking the structure to the downside, to the upside, this gives us a lot of insight on where the market wants to go for that given period of time. Now, how does it actually work? Well, the market accumulates in a range, gives a normal breakup structure to signal direction. So this is to the people that have very, very little understanding in the markets. They might be gambling or they're not really looking at the markets properly. This is what signals direction to them. So when they see this move happen, now they want to get in all of a sudden. Then it returns to a discount zone for buys or a premium for sells. Gives us a true breakup structure and then we enter. So essentially, most people get faked out by the first breakup structure. This is to fake them and trap them into doing the wrong thing. And then price turns to either a discount or a premium, and then we get a true breakup structure, and we can take our position into the market. Let me give you a quick example of what that looks like on the charts. As you can see here on the 5-minute time frame, so you see prices accumulating here, okay? Then we have our breakup structure right here. People start getting to sells. That's completely fine. So what market does is it pushes down. People are selling from here. They try to sell from this BNR zone. So their stop is up here. What the market does is it push down. It gives us a breakup structure here. We push down. Market comes back up. And then we take out all of the stop losses here. Then we have our true breakup structure, as you can see here. This is our true breakup structure after taking out the normal retail traders, and then we push down and we continue our trend to the downside. Very, very simple. Now the tip, a very, very important tip, is to wait for our true breakup structure, as this gives us our extra confirmation, increasing the win rate of our strategy. So obviously you can get in before the true breakup structure and take the risk. You can obviously get in before the true breakup structure, but obviously waiting for that true breakup structure is what gives us that extra confirmation, which in the long run increases your win rate. So it's pretty much much more safer. This is what I usually do. This is what I recommend for anyone that's just getting into trading or they want to take their trading to the next level. Always wait for the true breakup structure. It's really going to help you in the long run. Now, liquidity, everyone's favorite word, but it is very, very, very important. It's very, very crucial. Let me tell you why. Liquidity is what actually moves the market. Without liquidity, price would not move at all. Liquidity being all the dollars, or the pounds, or the yen, or the rupees being injected into the market. This is what makes the market moves, because at the end of the day, the market is being controlled by the banks, by hedge funds, by big companies. So their liquidity is what moves the markets. Every single stop loss, pending order, highs and lows, is liquidity waiting to be taken so that the big institutions can make their move. Now, here's what people usually do when they trade, and this is the right thing to do. What people usually do is they spot a good support and resistance zone. People place their stop losses at this zone and they trade the trend. Now, what proper order flow actually does is it pushes price past these levels, such as breakout zones, support and resistance, grabs liquidities, so it takes people's stop loss, and then price reverses. This is known as a liquidity sweep or a stop hunt. What you need to understand is price doesn't just move in one direction or it doesn't just pump out of nowhere. It's how big banks and institutions trick retailing into making the wrong move. So when normal people see these big pumps or these big moves happening, they're thinking that the market wants to go up now. They start spamming buys, start spamming sells. But this is what the big banks and the institutions do because they know people are gonna, enter at this time. So they're gonna inject as much liquidity as possible to the markets, trick people into making the wrong move. So now where they want to be selling, people will be buying, giving them liquidity for them to trade. What we want to be doing is taking the exact same move that the big banks and the institutions are making, so we can be profiting off their trend as well. Now, the goal, as I said, is to identify where the most liquidity is, catch the sweep or anticipate it before it actually happens. This is what separates proper traders from gamblers. Right now, moving on to step 3, session quarters. This one is very important. Session quarters, or the quarterly theory known as Q1, Q2, Q3, and Q4, are used to identify time fractals in the market, where the market changes behavior in terms of the range, the manipulation, and the distribution move, which is very crucial to understand the market phases and identifying the best times to take a setup. Now, Q1, which is accumulation, this is where market is trading in one range. We're not creating higher lows or higher highs. We're not creating either lower highs or lower lows. The market is just in a complete sideways trend. Now, Q2, which is the manipulation in the market. This is the big move that the banks and the institutions given. That big pump in the market. This is the one that trades retail into thinking that price is either going higher or either going lower, which is why it's called the manipulation, because everyone's getting manipulated. It's quite simple. Now, Q3 is the distribution move. So after everyone's been faked out, all stop losses have been taken, everyone's trading the wrong trend, the distribution is where the markets start to go in their intended directions. So the markets, such as the banks, the institutions, they're going to be putting in their positions. Now they're going to be trading the trend that they want to be trading. And then Q4, then there's the reversal. So when the banks and the institutions have completely come out of their positions and they've taken the trade that they wanted to take, price starts to reverse now because everybody is trading the trend that they wanted to trade. Now, Q4, known as the reversal, this is when the banks and the institutions have completely finished their positions. They've taken out all the liquidity, so now they're selling all their positions. Market starts to reverse in the opposite direction. So I'm sure you've heard of these times before. Q1, Q2, Q3, manipulation, AMD. I'm pretty sure you've heard of it before. You definitely have. This is how the market moves, but knowing when to get in is very crucial, or you will lose. It's happened to me time and again, but it comes down to skill and being able to identify the best times to get in. This can be applied across the yearly time frame all the way down to the M1. So AMD applies to every single time frame, as well as Q1, Q2, Q3, and Q4. It applies to every single time frame of the charts. And yeah, now step 4, POIs, PDRAs, and tricks in the market. Now, POIs, PDRAs, they're all the same thing. Everyone has their own terms for it. Now, these are used to get your entry points and identify good places in the market. So good places to place your positions would be order blocks after you have a liquidity sweep. So after we see that big fake move happening, the market starts to go in an intended direction. All the order blocks that are for example, we have a big push to the upside. We all understand that this is our manipulation. When price starts to trade down now, all the order blocks, all the bearish order blocks that we can take, these are the proper order blocks that we should be looking to enter from. Fair value gaps with good liquidity. And yeah, that's basically it. All the blocks after liquidity sweep and fair value gaps. This is all that I use pretty much. It's about identifying the right ones that hold and entering at the right time. Now, these are useful places in price action because it's where banks and big institutions like to fill their orders after manipulating price and collecting liquidity, such as the stop losses, pending orders, and all of that stuff. So after manipulating, price will come to these arrays and rebalance before distributing, restarting the whole cycle from the top to bottom again. You think of these areas like magnets and price. So for example, market starts to trade really high up. What price will do now is when we start to distribute, price taps into the order block, price trades back up, and then we trade back down. It's the whole EMD cycle, recycling itself. Alright, so this is an example of a good entry point that you can use as well. So identify the market trend, mark out timings and or fractals in price. So mark out Q1, Q2, Q3, and Q4. I've made a video on the indicators you can use to literally mark this out. It marks out everything for you, so everything is really on the charts. Make sure to check that out. I've included the link in the description to that video. Now, locate where the most liquidity is, and that's where the banks want to push price to. So identify the order blocks, identify the fair value gaps, the break blocks, whatever. Locate where the most liquidity is and look to take a position from there. Now, wait for timing to line up and enter when price hits a POY, and wait for a confirmation of price such as a TPOS. So wait for timing to line up, so wait for our distribution move to happen in Q3. When price hits a POY, wait for a confirmation like a true break of structure, then enter. And put your stops below your lows and your highs to protect your position and go BE as soon as you have a break of structure. This is to ensure that you're managing your risk properly, you're conserving your capital, and you're hitting very, very low stop losses in your journey. Now, the most important part, this is definitely the number one thing of trading. This is the one thing that holds a lot of people back: psychology. I'm going to be running through everything that you need to know about psychology. Number one, most important to manage your risks effectively. Risk is 0.5 to 1% max per trade, not more, not less. I mean, you can risk less if you want to, but risking 1% max per trade is the exact maximum that you want to be going to. Now, what you need to understand is trading is a long-term game. It's a long-term game, and it's a game of giving the markets as little as possible and making the most as possible. You want to preserve your capital, not give it to the markets. It's really 1% max. So if you're trading £1,000, for example, risk only 10%. I mean, risk really 1% max. That way you're going to be losing £10. That way, for you to lose all of your money, you'd have to lose 100 trades. So if you're hitting stop loss once, you hit take profit twice, hit stop loss 3 times, hit stop loss 4 times, but then you hit take profit 10 times, 5 times, you're always going to be ensuring that your risk is managed correctly. You're not going to be losing a lot of money, and you're going to be very consistent in the long run. Now, never move your stop loss because you're scared. You can't be scared in the markets. The markets don't give a toss about you. You just need to give it the same energy or you're going to lose. You can't go into the market with the mentality of, I'm not sure if the setup's going to hit, I'm really scared. This is why you need to wait for confirmation, be confident in yourself, ensure that you know what you're doing. So when you get into that position and you place your stop loss and you place your TP, you're not moving anything because you're confident in exactly what you're going to be doing. So don't move your stop loss because you're scared. Usually what happens is you move your stop loss maybe a little bit lower, or maybe you get out too early and the price hits your stop loss, or price takes you out and then price reverses in the direction that you wanted price to go in. Then you start to hit yourself, you start to feel some type of way because you've got to make a decision. So you just set one stop loss, one take profit, and stick with it. Price will hit either TP or stop loss. If price hits your stop loss, move on. Journal what happened wrong, move on. Now, journal. This is very, very crucial in your journey because it's going to allow you to, grow as a trader. It's going to allow you to understand where you're going wrong, where you're going right, what to capitalize on, and what to double down on, and what to remove in your journey. So, journal a lot is very, very crucial. Journal every loss and win you take. Journal every thought that you have, and if you're right or you're wrong. Journal to how the day, the week, the month, and how the year performed. This is what separates gamblers to 1% who actually take money from the markets, because as a good trader, if you're journaling, you're identifying everything that's going wrong, everything that's going right. So you're able to double down on what's going right, remove what's going wrong. I've created a video as well going on how you can journal, the exact same template that I use to journal, so make sure you check that out. Journaling is very, very crucial in understanding what's going right and what's going wrong and what needs to be changed. Now, focus in the process and don't get lost in the source. Don't strategy hop, don't move from one strategy to another. You know, there's thousands of strategies out there. Stick to one. All of them work. You know, people might be saying, "Oh, this strategy is better than this one." All of them work. You just need to stick to one strategy, perfect it, and make it the only strategy that you're using to trade. You know, strategy hopping doesn't work. You know, you might see somebody talking about this strategy, you might see somebody talk about that strategy, and you want to hop on it, now you want to hop on this strategy. It's just gonna waste your time. That stuff doesn't work. Stick to one, find one that suits you, and stick to it and stay consistent to it. You know, shiny object syndrome will only cluster your mind. You're gonna be thinking too much about your setups. You're gonna be doing way too much in the markets. This is only gonna hinder your performance. So make sure you stay onto one strategy. Do strategy hop. Just focus on that strategy and master it. That's very simple. You know, that's the full guide to reading how the markets move. I hope you enjoyed this video.